Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I will be taking you through how to account for convertible bond on initial measurement and subsequent measurement. Now let's look at the question. This question is an extra from a full past question. So I've made the extra just to illustrate how to account for the convertible bond. So we have an extra from the trial balance, and it relates to Downing Co. as at 31st March 2016. So in this trial balance, I have the 5% convertible loan notes. The value is 30 million. Now, loan interest paid 1,500. Now you can verify this by looking at the 30 million times the 5% nominal interest or coupon. So 30,000 times the 5% will give you 1,500. Now the reason you are doing this is to reconcile whether the full interest was paid at the year end. If the full interest was not paid, then a portion of that interest would have to be represented as a current liability under the financial position statement. But in this case, the full interest for the year was paid. Now let's look at additional information. Darling Co. issued $300,000, $100, 5%. So that is how come you have the 30 million. Because when you multiply 300,000 times 100, you get 30 million. On 1st April 2015, again, you need to reconcile this to the year end, and that is a full year. So the start 1st April 2015 to 31st March 2016, that gives you 12 months. The loan notes can be converted to equity shares on the basis of 25 shares for each 100 loan note on 31st March 2018. So you look at the maturity period. So 2016, 17, 18, that is 3 years. 3 years. Now, in accounting for the convertible loan note, we ignore the dilutive effect of that, because that will be needed when we are calculating diluted earnings per share. So we don't need that now. An equivalent loan note without a conversion right would have required an interest rate of 8%. And this is what we need to split the instrument into equity and debt at initial measurement. Now we're given the discount factors for 5% and 8%, and we don't need this one because this is the coupon. We need a similar loan note without the conversion rights. So now let's see the accounting, the initial measurement. So initial measurement. We want to look at the debt and equity component. So we split. And the way we do that is to discount the cash flow. So we find the present value of cash flows. So I'll have, let's say, years. I have year 1 to 3, and I have year 3. And the cash flows, I'll have the interest, then the dollar amount, I'll have the discount factor, and I'll have the present value. Now, please watch this. The year 3 would be the principal. And it means that the interest, which is calculated as 1,500 a year, which is the coupon, which is the cash flows on the instrument, becomes annuity for the 3 years. So what I'll do here is to say that the discount factor we are given, please, the discount factor we are given here, I'll add them up to find the annuity factor. So I have 0.93 plus 0.86 plus 0.79 That gives me 2.58, and that is the annuity factor. So 2.58. So 2.58 times 1,500, that gives me 3,870. Then at maturity, the amount, which is 30,000,000, would have to be what? Discounted using the third year discount factor, which is 0.79. So 30,000 times 0.79, that will give us 23,700. When you add plus 3,870, that gives us 27,570. It means that this is the debt. Therefore, the equity will be the difference. So the difference between the total value of the instrument. So we take this from 30,000, we have 2,430. So the 2,430 becomes the equity option to be shown in the financial position statement under the equity section. So the next thing to look at is what happens on subsequent measurement. And the subsequent measurement here, we are looking at the year end. So subsequent measurement, i.e. year end 31st March 2016. So at the year end, we have to find the amortization. So if, let's say, this is my workings 2, then I'll say loan amortization. So I can find the finance cost and also the liability value at the end. So here, it is the year end 31st March 2016. So we are doing it only for the first year. So the opening balance, which is the figure we had from here, this is 27,570. Then we have the finance cost, which is the effective interest, will be based on 8%. And we have the actual interest paid, which is 5% of the coupon, and that we know is 1,500, which is, then we can have the closing balance. Now here, what we will have is the 27,570 times 8%. That should give us 2205.6. So let me run it up to 2206. So to do this, I have 27,570 plus 2206 minus 1,500. That should give me 28,276. So in illustrating this on the face of the financial statement, so in P&L, we would have finance cost, which is 2, let's say all of these are in thousands, 2206. And in the financial position statement, under non-current, okay, let me take the equity first. Under equity, I'll have equity option. Let's say this is my workings 1, this is my workings 2. You have to make the reference. So the equity option here is 2430. So 2430. And then I can go down and say the non-current liability. And this would be the 5% convertible loan note, and that will also be workings 2, and the value will be 28,276. So this is how we account for the loan note, right from initial measurement to subsequent measurement, and how you present these figures on the face of the financial statement. So it's important you know the process. First, you split into equity and debt by discounting the cash flows with equivalent or a similar loan note without conversion right. And that will give you the equity option and then the debt. And then the subsequent measurement is for you to what? Find amortization of the loan note. So you can find the finance cost, which is the effective interest. This is the same as the effective interest, which will be expensed to P&L. And then you can find the closing balance. I hope this helps you in your preparation for the FR exam. Please subscribe to this channel to receive updates on new videos.